you spend time, you guys have interviewed the sort of top 10 strategists going through what they think is going to happen in 2019.
That's right. This is an annual exercise we do. We survey 10 market strategists. They're both from Wall Street banks, Citi, JP Morgan, Goldman, Morgan Stanley, asset managers, Nuveen, PGIM, Federated, for example. And we get their views on where they see the S&P 500 ending next year, where they see the 10-year, where they see the economy next year.
And where do they see it?
Well, with the stocks, they see the S&P 500, the consensus or the median is a gain of 14% from where we are now.
Jesus.
So that's...
So, okay,
well, let's keep in mind that
right now. This is great.
It certainly adds to the discussion you've all been having this morning. But so market strategists are by nature tend to be optimistic, but they have reasons to be optimistic in the sense that this economy is still fairly robust. Although there are certainly warning signs. Consumers are still confident. Corporate buybacks and dividends.
Here's the question: when you guys when you've looked at their track record over the years, right?
Yes.
Is this a positive indicator or a contraindicator of what ultimately happens? We always talk about the contraindicator of Davos, for example. We go to Davos, everyone's very excited, and then the opposite happens, where they're all down and then they're pessimistic, and then they should have been optimistic.
I think in recent years, I think if you were to blend the yearly forecasts, it would average out to something that's pretty close on track. But last year, for example, they were much more optimistic about this year, which hasn't proved the case.
Right.
For 2017, they were much more pessimistic, which was a much better year. So one can draw conclusions from that.
You guys have picked out 3 stocks that it seems like people seem to, that across the board, this group seems to like: Toll Brothers, Bank of America, and Apple.
Right. So that's 3 from a list of 10 that our chief stock writer, Andrew Berry, discussed. So in several of them are somewhat contrary in place. Home builders, for example, has been beat up all year. Toll Brothers is a very profitable company, and it's in the high-end luxury end of the market. It's trading for essentially book value, so we think there's a lot of potential there.
Right. Ken, that's your world. What do you think on Toll?
Look, there is a shortage in housing when you do the numbers, and there's changes in lifestyle. Kids are now leaving home and setting up their homes. There was an article I read yesterday about apartments, about rental units, the way it's going up. There's a demand for housing here. And right now, I think once the market adjusts to higher interest rates and higher monthly rates, what they're going to pay for a mortgage, I think we're going to be fine.
Right.
We need housing in America. We need it. How do I feel? Feel good.
Bank of America and Apple. What's
right. So Bank of America, I mean, big banks, another very unloved group, and given the state of the economy, given the buyback programs all the big banks have been doing, there's reason to be optimistic about all the banks, maybe less so Goldman Sachs and Wells Fargo for their own particular problems. So of that group, we especially like Bank of America because it's very aggressive with buybacks, because it's U.S. focused.
And they got a great franchise. You look at the Merrill Lynch franchise. Brian's done a hell of a job of running. Tom Montag, what he's done with Merrill. I mean, these are great franchises, and you're not paying much money for them.
We got to run, but how much is the Fed factor into all of this? In terms of what this group was thinking about? They
were thinking about, last year they were thinking that we'd be at 2.25 with the federal funds rate. They're not, we're looking ahead to 1 or 2 more hikes next year.